Let's talk about insurance. I know for many working adults, insurance can be complicated and confusing. It was the same for me too when I first entered the workforce. I have questions such as, what insurance to buy? How much coverage do I need? Am I buying too many insurance? And why the heck are some premiums so expensive? So after 11 years as a working adult, here's everything I know about insurance and the current plans I have and their corresponding premiums. Just a disclaimer though, I'm not a licensed or trained financial advisor. Thus, anything in this video henceforth is based on my own opinion, experience, and research. So with that out of the way, let's now look at what exactly is insurance all about. If you look at the definition, insurance is a way to manage risks and is purchased to protect against unexpected financial losses, and that the insurance company pays you if something bad happens to you. So essentially, insurance is bought to provide cash when unexpected life events or situations happen. Some of these unexpected life events could be accidents, illnesses, hospitalization, or even death. Now that we are clear on the purpose of insurance, let's now look at some of the common insurance plans on the market that cater for such life events. First up will be life insurance plans. These insurance plans covers a portion of hospitalization fees and certain surgical procedures and treatments. By default, all Singaporeans and PRs are covered with a baseline health insurance plan called MediShield Life, and its premiums are fully paid with funds for the MediSave account. Under MediShield Life, up to 100% of ward and treatment charges for Class B2 wards and below at government hospitals are covered. Anything above Class B2 wards or wards in private hospitals will receive prorated coverage instead. In addition to coverage for ward and treatment charges, MediShield Life also has claim limits for certain surgical procedures and treatments. The important thing to note here will be the claim limits for cancer drug treatment and cancer drug services, which has been changed since 1st April 2023. If you're looking for an upgrade to MediShield Life, that's where private health insurance plans comes in. For myself, I went with a health insurance plan from AIA and also got an additional rider option on top of it. For this, I paid an annual premium of $788.28 in 2023, consisting of $552.10 for MediSave and $236.18 in cash. I opted for coverage for Class A wards in government hospitals instead of being covered all the way to wards in private hospitals. My reason for this is that in the event of an emergency, I do not foresee myself seeking treatment at a private hospital due to generally higher costs than government hospitals. Also, let's not forget that health insurance plans do not cover all hospital-related charges, which should definitely be higher at private hospitals. On top of the extended coverage for ward and treatment charges, my health insurance plan also has enhanced claim limits for cancer drug treatment and services. Moving on for health insurance plans, next up will be disability income insurance. As the term might suggest, this insurance provides you with a portion of monthly income should you become disabled and not be able to work. For most disability income insurance, there will be a terminal age for payouts, or they will cease once you are able to return to work. Like health insurance plan, there's also a baseline disability income insurance for Singaporeans and PR aged 30 years old and above, and that is CareShield Life. Under CareShield Life, you would receive a monthly payout that will be fixed for a period of severe disability once the claim starts. And the conditions for the claim would be if you are unable to perform 3 or more activity of daily livings. Currently, my annual premium for CareShield Life stands at $181.05 after transitional subsidy and also fully payable via MediSave. Personally, I opted to add an additional private disability income insurance on top of CareShield Life as I felt that the payouts were not sufficient should I really become disabled and not be able to work. Hence, I went for disability income insurance under the MHA Group Insurance Plan, which cost me a monthly premium of $9.07 for annual payout coverage of $20,400. This means that if I become disabled and not be able to work, I will receive a monthly payout of $1,700 on top of the payout from CareShield Life. If you are planning to get private disability income insurance, do look through the policy details carefully to see what is being defined as disability, as this might differ between different insurance companies. Also, do be aware of the percentage of monthly income that will be paid out and when exactly a payout would occur. As an extension to disability income insurance, you may also want to consider getting a personal accident insurance plan. Personal accident insurance plans pay out a lump sum amount in the event of death, total permanent disablement, or total permanent dismemberment due to accidents. Most of such plans will also pay out a portion of the coverage in the event of injuries due to accidents. Currently, I have a $600,000 personal accident coverage under the MHA Group Insurance Plan, which cost me a monthly premium of just $3. While the maximum coverage is at $1 million, I do not see the need to go to the limit, as I also have life insurance plan, which I will cover later in the video. While I got a pretty generic personal accident insurance plan for myself, you may want to consider other personal accident plans with additional benefits such as child support or coverage or infectious diseases, etc. However, do be mindful of the additional premium that you most likely be paying and determine for yourself whether it's worth it or not. Now, let's move on to critical illness insurance. These insurance plans normally pay out in the event of illnesses such as cancer, heart attack, or stroke. For critical illness insurance, they normally fall into two camps: single lump sum payout or multi-pay options with differing conditions. They can then be further broken down into which stage of critical illness the insurance plan covers for. If you're not aware, there is a standardized definition of severe stage for 37 critical illnesses that all insurance companies in Singapore abide by. However, when it comes to early, intermediate, or most severe stage of critical illness, insurance companies have discretion to define it themselves. Hence, every insurance company will have its own specifics and conditions for these stages of critical illnesses. For myself, I went with a multi-pay critical illness insurance plan from Aviva, which covers early and intermediate stages of certain illnesses, severe stage of critical illnesses, and also major cancers, heart attack, and stroke. I went for a coverage of $100,000 and paid an annual premium of $1,859. The thing about multi-pay critical illness is that they offer a multiplier payout based on the coverage that you have. For instance, my critical illness plan with Aviva pays out a 3-time payout for severe stage of 36 critical illnesses and 2 times 1.5-time payout for major cancers, heart attack, and stroke, with a waiting period of 2 years in between. Honestly, if you ask me, I'm not really sure if my critical illness plan is value for money or not, so I will most likely review it and do a comparison soon. We have now come to life insurance plans, where payouts normally occur in the event of death or total permanent disability. Most life insurance plans also offer an add-on option for payout in the event of critical illness onset. For life insurance plan, you have an option of either a term life plan or whole life insurance plan. The difference between the two, on top of just the premiums paid, is the duration and cash value of the policy. For term life insurance, they expire worthless at a certain age limit. Most term life insurance plans expire either at age 65 or 70 years old. Also, most Singaporeans and PRs will already be covered with a basic term life plan, known as a Dependence Protection Scheme, or DPS for short. So DPS is a term life plan that pays out 70k in the event of death, terminal illness onset, or total permanent disability till the age of 59. Thereafter, the coverage will then decrease to 55k for the age of 60 to 64, when the term plan will then expire. Premiums are fully paid via your CPF funds. As compared to term plans, whole life insurance provides you payout for the entirety of your life, or at least till the age of 100 years old. Some whole life insurance plans have reduced coverage in later parts of your life. Also, most whole life insurance plans offer you a cash value should you choose to surrender the plan at the age of 70 years old. Despite the cash value of whole life insurance plan, I went for a term life insurance plan with Aviva for coverage of $1 million. This cost me an annual premium of $626.50. The reason for me to choose term plan over whole life insurance is quite simple actually. Personally for me, I prioritize the amount of coverage as I believe that is the most important thing should anything untoward happen to me. As such, from a cost to payout perspective, term plan just makes sense for me. Besides the above insurance plan mentioned, there could also be other insurance plans which will be applicable to you. For instance, if you own a property, an additional private home insurance plan could be useful on top of a mandated fire insurance either from the bank or HDB. For those who have domestic helpers, you may also want to consider getting maid insurance for your helper. The bottom line is, whatever insurance plan you purchase, always weigh the cost to coverage and probability ratio. You definitely do not want to overpay or over-insure for really niche events. Having mainly looked at insurance plans that pay out in the event of unexpected life situations, let's now look at insurance plans that have a dual role of protection and growing your money at the same time. And these are endowment plans or investment-linked policies, otherwise known as ILPs. The difference in endowment plans and ILPs is the participating funds plans that your premiums go towards. For endowment plans, your premiums will be invested in a mixture of funds with fixed income securities and equities. There's also a guaranteed portion of payout exceeding the premiums paid when the endowment plan matures. ILPs, on the other hand, allows you to have more freedom to choose which funds your premiums will be invested in, so you could potentially get a higher return than endowment plans. However, most ILPs do not have a guaranteed portion of payout, or their guaranteed portion of payout will be lesser than the premiums paid in total. Currently, I have two endowment plans from Prudential and AIA, which cost me $3,567.52 and $3,253 in annual premiums, respectively. In total, it cost me $6,820.52 to service these two endowment plans every year. Yes, I know that's a lot. On the bright side, my last premium paying year for the AIA plan will be next year. However, I will still have to service the Prudential plan till I'm aged 44. Or until 2036. Fuck me. As a whole, I would advise individuals against purchasing long-term endowment plans or ILPs. This is due to the fact that returns aren't that great, and growing your money by yourself will most likely fetch higher returns. If you look at the guaranteed returns for my AIA endowment plan, it only offers 28.1% return after 24 years. If the non-guaranteed returns were added in, the highest illustrated return would be 126.4% return after 24 years. If I were to use the performance of the two endowment plans till date as an example, the accumulated bonus for the AIA plan will be $5,178.88, which is very close to the illustrated return on the policy. For the Prudential plan, the accumulated bonus will be $3,116.19, which was lower than the illustrated returns of the policy. Now, I'm not implying which company is better with their endowment plans, but I thought it would be useful to pull out some real-world comparisons to illustrated returns in endowment plan policies. Granted, this is a very small sample size, so do with this information what you will. In addition to the issue of returns, endowment plans and ILPs cannot be cashed out before maturity without incurring significant losses. This will work against you in times of emergency where cash is readily needed. Before ending this video, I thought it would be useful to include a section on my mistakes made and also some tips when it comes to purchasing insurance plans. I think my first mistake is really quite obvious when it came to the purchase of endowment plans, which is to blur the lines between investing and insurance. For most situations, it will be more cost effective to focus purely on either insurance or investment. Although I'll argue that you're better off not purchasing investment plans from insurance companies. This is due to the fact that for endowment plans and ILPs, a portion of the premiums are funded towards paying for the protection part of the plan. Secondly, when it comes to purchasing insurance plans, do not be pressurized or intimidated by sales tactics of the insurance agent or financial advisor. A common tactic used would be the illustration of worst case scenarios of individuals who chalk up huge medical expenses due to the fact that they are underinsured. Or the aspect of investment plans, they will show the attractive advertised returns without mentioning the terms and conditions, risk disclosures, and the amount of administrative and management fees that are involved. If you're an individual who have difficulty saying no, like I was in my early days purchasing insurance plans, it is useful to know that all insurance plans come with a 14-day free look period from the date that you receive the policy document. Within this time period, you can cancel the policy without any penalty. So make use of this time to really go through the policy, and if you found that it's not beneficial or useful for you, just cancel it without any fear. Thirdly, over the years, I realized that it's not necessary to purchase the highest tier in every insurance plan. You'll be better off structuring your insurance needs based on your circumstances and realistic scenarios in your life. For instance, when determining your coverage for life insurance plans, consider the number of dependents you'll be leaving behind and the amount of income you will need should something untoward happen to you. You can also use industry advice when it comes to certain coverage. For example, the recommended critical illness coverage is roughly around 5 times your annual income. Besides getting the appropriate coverage, it's so wise to compare insurance plans from different insurance companies. For this, you can use a website called Compare First to compare life insurance plans, endowment plans, and ILPs across various insurance companies. The Ministry of Health website saw a comparison for various health insurance plans with their corresponding rider options. Lastly, When it comes to insurance plans, do not be afraid to surrender a plan if it's no longer beneficial or useful to you. While some plans come with penalty for surrendering them early, sometimes it is best to take a short-term loss as compared to a long-term pain. So yup, those are some tips I have when it comes to buying your own insurance plans. For myself, currently I have 7 insurance plans which cost me a total annual premium of $9,687.04. Honestly, if you ask me, I think that's a little bit too high, but a bulk of it is due to the 2 endowment plans. However, I've already treated them as a portion of my necessary expenses for the year. And thankfully, I'll no longer need to pay for one starting from next year onwards. So, for all working adults out there, learn from my mistakes and construct your own value for money insurance portfolio. With that, I will see you all in the next video. Goodbye.